the 5 best trading strategies. So we're going to go through moving average, swing, crossovers, RSI analysis, price action, 24 candlesticks, range bounded trading, breakout, 24 breakout patterns. Masterclass lesson 12, moving average, swing, crossovers. So we're going to talk about the trading strategy now. So here's an example of how the moving averages crossovers work. What is a moving average? A moving average is a curving trend line which shows you average prices of a market over a specific period of time. We use moving averages to help identify the past, current, and potentially future trends. Wait a second, what did he just say? So let's go back and let's break it down very slowly. A moving average, so it's these squiggly lines, is a curving trend line which shows you the average prices. So each point of these moving average shows you the average prices of a market. So it can be any market, stocks, indices, commodities, Forex, crypto, over a specific period of time. So this is a time frame that we chose. We'll say daily. And it basically makes up the average prices over a certain amount of days. We're going to use simple moving averages. And the reason is because I understand it better. If you overlay simple moving average and exponential moving average on a chart, you'll pretty much see they are quite similar. And so I'd rather use simple moving average because I want to understand what I'm doing. So let's use a 7 moving average as an example. So 7 moving average is basically where you take the closing prices of 7 prices and you divide it by the number of periods that you are looking at. So you would divide it by 7. So 7 prices, you know, if it's trading at 179, 180, 182, 184, whatever, you add up those prices over 7 and you divide it by 7 and it will give you a point on the moving average. And so the fast moving average, for example, is 7, will show it closer to the price than a slower moving average, such as 21 and such as a 200-day moving average. We use moving averages to help identify the past, the current, and potentially the future trends. The past is what we see occurred with the prices on a chart. The current is seeing where are we with the moving averages. So right now, the 7 is above the 21. The price is moving up. The price is above the 200-day moving average. So where is the market more likely to move? Future trend, up. Swing crossovers. So here's the first trading strategy. I don't know what has happened over the last couple of years, but swing trading has been called something different than when I started. So in 2003 up until 2014, 15, swing trading was basically 2 moving averages or that have crossed and that you're going to constantly swing and buy a market and then sell a market and then buy and then sell and just swing your positions from long to short to long to short. And not just with moving averages, it can also be with one moving average where the price closes above the moving average, you go long, and if the price closes below the moving average, you go short. Anyway, it doesn't only apply to moving averages. It's just constantly being in the market and swinging from long to short. The swing crossovers, for example, with the 7 moving average and the 21 moving average, the buy signal is when the 7 moving average crosses above the 21 moving average, okay? And when the price confirms and opens above, that is where you go long. So you go long, you buy at this level, and you hold, and you wait for the market to cross over and confirm. So some people have a confirmed motion saying that if the line is touching the moving average, I'm going to remain in my position because it might be a short-term retraction or contraction and retracement, and then it's going to continue up, which it did. So you hold on to your position, it's touching the moving average. And by the way, this is one of the secrets that people don't tell you about of when do you switch to a short. So touches, you carry on holding, still looks good. Then it crosses, okay, confirmed. It's actually broken apart. And some people make these moving averages a lot thinner to confirm. Others make it a lot thicker so that they will handle the sideways movement or the retracement before the market continues up. So they held on to this price at, dare I say, 145, or let's say 147. They held on, the market moved up. You can see this is a daily chart. And then when it crossed over, they got out at 195. In this case, it would be dollars. So they got out at 195, they got in at 147, they banked the profit, but you don't close the trade, you swing. So you shorted at a certain price. You then obviously over here, you would have taken a loss because sideways motions do not work well with crossovers. And then over here, you went long again, the market moved up, and here you banked another profit. Here you probably would have banked a loss. You're also holding on to an extended period of time, and then the costs are starting to accumulate due to the interest costs that are added on. So it crossed below, down, you shorted, and you took a loss. So you took a loss here, you took a profit, you took a very nice profit here, you took a loss, and here you shorted it, and you took a major profit over here again. And you're just holding on, and there is no guessing. There is no gut feeling. You're just going with the strategy. What time period would you recommend for swing trading? I would recommend daily. Personality thing. I do know traders that are still using hourly charts and 30 minutes. It's a lot of work. If you do not want to be sitting in front of a screen and going back to the rat race, just taking trades every single day, based on conditions that you cannot control, I would also stick to daily. So daily is perfect for this type of swing trading. And also, I do not swing trade stocks, because being in a market in stocks, there is higher risk at liquidations, manipulation. Things can happen overnight. There can be a crash in the market. And the longer you're exposed inside a certain stock, there are higher chance that you will possibly be caught in the crossfire. So I love trading indices when it comes to swing crossovers. Do you use SMA or MA? SMA, as far as I know, is MA. Simple moving average is a moving average. A moving average is a simple moving average is clearly that. It is taking a certain amount of prices, dividing it by the number of periods that you've added onto those prices. Moving average might be a collection of different moving averages. So there's an exponential moving average, there's a VWAP moving average, there's a volume weighted moving average, there's exponential, I think I said that. So I choose SMA because it makes life a lot easier to understand. Let's move on. You have your buy signal, you have your sell signal, and then you have another style of swing trading, which is with a 200-day moving average, where you are always in the market and you are long and short, and you're using the most powerful moving average in the world, the 200-day moving average. And why is it the most powerful? Well, there are a few reasons, but I don't have the exact reasons. One is that there are possibly only 200 working days in a year, so it does make up for the 200 that are taking place within the working period. Two, there is confirmation bias, that people have just depended on this 200-day moving average. When the price moves up and people see it above the 200-day moving average, the self-confirmation or confirmation bias is that many other traders and billionaires and institutions and market makers and banks are seeing the exact same thing and are acting accordingly. So the 200-day moving average is the most powerful moving average in the whole of technical analysis and trading. So with swing trading, the 200-day moving average, you're also always in the market, long and short. You're swinging in, you're swinging out. You get in, you go long, you're waiting for your criteria for the candlesticks to confirm, close below. You're holding it, you're holding it. Then it closes below, you get out, you swing short. Here, you would have thought you were making an absolute killing. The market was crashing good 10, 20%. And then it just recovered straight too. And then you were saying, I should have gotten out. I should have banked my profit. The market was really right there. But you got to follow the strategy. And when you follow the strategy and you're following the rules, that's when you celebrate. You don't celebrate when you take a premature profit without following the strategy. In fact, you're punishing yourself because trading is not a short-term thing. So don't worry about these little situations. I had it recently I sent out a Forex trade and it was just a few cents away from the take profit. And then it went and hit the stop loss. And I'm not worried. I've seen this a million times. It's part of the trading thing. As long as I didn't go against the strategy, I'm winning. Market closed up, you went long. And then there was this position where you got in, you went long, and you held it. And take a look at that. You would have made up for any loss that would have taken place over the whole year just because of this little trade where they followed the trend. And then here you would currently be going short. You don't know if the situation will form again, so you just continue to hold the market. You're always in the market when you're swinging and you're following using the 200-day moving average. Very nice strategy. Next we have is swing with the 50-day moving average. So if the 200-day moving average is too slow for you, you can use the 50-day moving average instead. But I warn you that there are going to be a lot more trades that you're going to be taking and a lot more disappointments when the market does start trading sideways. Also on Forex and indices for 200 SMA, yes, you do. You use the 200 SMA on pretty much any market and any stock, any cryptocurrency. What I can say is that sometimes certain stocks act differently with certain moving averages. So if you do decide to put a moving average onto a certain stock to follow, see which one fits that stock specifically. So 21 moving average, I find, is a really good moving average for stocks, and 7, because when 7 crosses above the 21, the trend is more likely moving up. When the 21 crosses below the 7, the trend is more likely to move down. Masterclass lesson 13, the relative strength index, or the RSI. So the RSI, the relative strength index, looks like this. It is used to measure the speed and change of price movements. It measures the strength of its trend direction up, down, and sideways on any market by monitoring the changes in its closing price. So what's important to note about the RSI, and we're now talking about the anatomy, is that it is a closed oscillator. And what I mean by a closed oscillator is that it has a limit between 0 and 100, and then stops right there. Right. So with the RSI between 70 and 100, we say that it is overbought. And overbought is basically where the market is at a certain price beyond high. The buyers are going to start fading out. So the market moves up, there's buying, and the demand is increasing. And then when it gets to the point where there's been so much buying, it forms a little bubble. So it forms a little bubble, and at the overbought levels, we can expect the price to then start dropping and for the sellers to start kicking in, which will drop the price. Between 70 and 100 is overbought, where there is a lot of supply and a lot of buyers that have bought into the market, and now the sellers want to take over. Then you have the oversold level, which is between 30 and 0, where you have the market that has been selling and the price has been going down. And now at a certain level, the buyers are going to say, hold on, the market is now quite low, and we are going to start buying the market to push it back up. So the overbought zone is where the X is above 70. And this gives a selling opportunity in a trending market that's moving up. And the oversold, which is the X is less than 30, is a buy opportunity for where the market has been coming down. All right. Notice I use the word trending market. Then we have the market environment, which is also very important. Now, the way I see it with RSI, not everyone sees it this way, but I like to use the 50 level of the RSI to determine whether the market is in a bullish momentum or in a bearish momentum. Between 50 and 100, when the RSI crosses above 50, it is in a bullish territory. This is where the buys are kicking in, okay? Then you have between 0 and 50, where I like to call it a bearish territory, where the sellers are still dominating the market and the price is more likely to continue down, or it is in a downtrend. In a trending momentum market, not sideways, Sideways, these indicators are null and void. I tell you that much. They do not work in sideways markets. It does not apply with a sideways trend ever. So the 50 mark is the neutral zone that you can determine where the price you want it to break up for going into a bullish territory for the price to move up, or break below the 50 to enter into a bearish territory. So now let's talk about divergences, which is probably the most important element to RSI when trading a market. So the first thing, the two divergences that we're talking about is a bearish divergence and a bullish divergence. So the first one is, let's talk about a bearish divergence. A bearish divergence is where the price of the market is moving up and the RSI momentum is moving down. This tells you that the buying that is taking place within the price is not as strong and convincing, and therefore you can expect the price to drop. So this is what happens. The price moves up and the RSI drops. And how you use this is because you're using the resistance or the ceiling level that I explained earlier, where they are making lower high prices. And when it makes lower high prices, well, the price is making higher lows. Then basically it's saying that the momentum of the RSI is showing bearish divergence, where the price is now more likely to move down and break down, which it exactly did at this point. The RSI in this case formed a bullish divergence, and a bullish divergence is where it started forming higher low prices. Okay, so it formed higher low prices. Well, the market was making lower highs. Now this is known as a bullish divergence, where the price is coming down and the RSI momentum is going up. And this is an indication that the price is more likely to move up. We have the RSI indicator at the bottom and we have a price at the top. Where is the lowest low and what is the next low? This momentum is showing that the RSI is moving up in momentum. Then let's see what is going on here. So at this point, there's a low price, and at this point, there is a high low. So what you can say is that there is a confirmation divergence, that there is bullishness in the market. So when the price of the RSI is moving up and the price of the market is moving up, there is a high chance that the momentum will continue, which is exactly what it did and looks good. When the price broke above the 50 mark, the upward momentum continued. And when the price broke below the 50 mark, the downward momentum continued. And now at this level, we can say that the market is overbought, but you do want to follow the trend and have other indicators in the background to help you confirm of where the market is more likely to go. Can we use the 4 moving averages simultaneously? Okay, so moving back to the moving averages. Yes, you can use them simultaneously when the 7 moving average is above the 21, above the 50, above the 200-day, and they've all crossed up. Then that could give a great confirmation signal that you can go long. The problem with using 4 moving averages is that for the 200-day moving average to cross below and for that to be your signal to sell again could be too late. You could have missed the entire movement of the trend. So I use less moving averages when it comes to trading strategies, because the more moving averages, the more you have to wait. And the best price of indication of a trend changing is 2 things: your eyes and the price action. So if you're waiting for a 200-day moving average to cross, you would have missed out. Would the volume be weak on bullish and bearish divergence? Yes, right. But we are entering into a completely different trading strategy called VSA. Volume spread analysis is another completely different analysis based on volume. When volume's going up and price is going up, there's confirmation. When the price is going down, the volume's going up, there's confirmation of a trend. There are many different ways, but look up volume spread analysis. Tom Williams has a brilliant book on it, and you can. Does the RSI have a time period? I use 18, but you can use 20. 20 and 18 are very similar. You can go into the settings. Sometimes there is a moving average placed on the RSI. I think it's too cluttered. I also like to remove the moving average. I want my charts to be clean and visible. Also make the RSI, instead of blue, for example, I make it black so I can see exactly the difference between overbought and oversold and in between the 50. So it's all based on visual appearance with how you like the RSI. You will see that here is the RSI summary in 3 trading signals. Sorry, the overbought trend lines, the bullish and bearish. These are all different types of trading signals that you can watch out for with the RSI. Masterclass lesson 14, price action candlesticks charting. The 24 most popular candlestick formations. So now I know a book that a Japanese guy wrote. I forgot what it's called. I think the book is called Candlesticks, and it's like hundreds and hundreds of pages. And it explains these few candlesticks with such jargon, and it's laborious, and it just goes on and on and on. And I'm reading it, and I'm like, maybe I'll gain extra information that no one else will ever know. And nope, it's just explaining and going around in circles. So I want to explain to you the 24 most powerful candle chart patterns that I've ever seen in bullish versus bearish. I'm sure that will help. This is one of the reasons that you're here today, is to learn these candlesticks for once and for all. So let's look at the first candlestick pattern. Remember in the beginning when I explained the basics of candlesticks, there was a reason I did that, and that is so that I can now explain the formations of the candlesticks. The first one is bullish engulfing. The bullish engulfing is where the green candle engulfs or eats away the previous candle's movement. So in this case, there is a small down candle, and then it made this bullish engulfing candle, ate the small one, and basically is saying, nope, we're not going down, we are going up. That is a strong bullish candle. You then have the opposite, which is a bearish engulfing, where you have this big bearish engulfing candle eating the little up candle. Momentum is not going up. We are going down. We are taking over. The sellers are going to win. Let's go, guys. Down we go. So that's the difference between a bullish engulfing and a bearish engulfing. After this, you'll never forget these candle patterns the way I'm explaining. Then you have the bullish marubozu. Sounds Zulu. It's Japanese. So the bullish marubozu. And this is like an engulfing candle, but the difference is that there are no wicks. So there's no wicks. It is just a complete body of a candle, of an up candle, where the open price is equal to the low and the closing price is equal to the high, and there are no wicks. So that's the bullish marubozu formation. Then you have the bearish marubozu, where the open price is equal to the high price and the closing price is equal to the low price. And it's basically saying that the bears are winning, the sellers are winning, and the market is more likely to head down. Then we have a bullish hammer, which are very common, and very seldom you can make confirmation decisions on whether you're going to buy or sell. But anyway, here it is. A bullish hammer is where the open price is equal to the high price is equal to the closed price, and it forms some type of hammer, but saying that the buyers won this candle in this case. And obviously the opposite would be a bearish hammer, where the open price is equal to the high price and there is a closing price of the candle, and in between, so there is a small body and a huge wick, and it looks like a hammer. It's as simple as that. So there is a bullish and bearish, bullish hammer and bearish hammer candlestick formation. We then have the bullish pin bars. And the bullish pin bars is where there are two pretty much identical twins of candles that has formed first the down candle between the open and close, and then the next candle where we have the open and close, and basically they cancel each other out, and it's saying that we are not going down, we are going up. So that's the bullish pin bar. And opposite, we have the bearish pin bar, where not only is it between where the open and close is for the down candle and up candle, but it's also with how big the wick is. So in this case, you can see that the bears won where the candle closed, but the up candle, you can see that the market went down to test that level, failed to break below, closed above, and is showing bullishness to come. Similar with the bearish pin bar, where it formed a bearish candle, the up candle went up, failed to confirm, went back down and closed above the close. So once again, these are not confirmation candles. These are just names of the candles that you can use. Bullish harami. So the bullish harami and the bearish harami. Harami, as far as I know, means pregnant. And the bullish harami is basically saying that there is a mother candle. There is a mother candle who's a down candle, and it has just given birth to a baby up candle. That's how I can explain it. So the bullish harami with the bearish candle, where the mother has given birth to the baby candle, and the baby candle is in between the mother's body. So that's how you can establish of between a bullish harami. Then we have the bearish harami, where the mother is an up candle, and it is quite a large candle, and it's given birth to a baby down candle, which is it confirming that there's downside to come? Like I said, do not use individual candles for confirmation. Use other indicators, use momentum, use trend lines, and then take a look and say, all right, boom, there's a bearish harami. How is it looking in relation to other indicators? The bullish spinning top and the bearish spinning top. So the open is below the closing price for the up candle, but you can see that it looks like a spinning top. The wick between the high and the closing price is very similar to the wick between the open price and the low. Similar to the bearish spinning top, the open has quite a large wick between the high and the open, and the close and the low. So bullish spinning top and bearish spinning top. Dragonfly doji. This is one of the most bullish candlestick charts that you can get when it comes to trading. And basically it's saying that the price opened at a certain level. Then there was testing and supply where the sellers brought down the price to a certain low. And then it went right back up to the high where it opened, and it closed exactly where the high and the open is. This is a dragonfly doji. It's bullish. And it's a good signal sometimes for reversal in a trend. You then have the gravestone doji, which is the opposite, where the price opened at a level, the market moved up to a certain high, it went right back down, and it closed at the low, which is also where the open is, and it formed a gravestone doji, which can also indicate a reversal of a trend. So if the market's moving up and then you see a gravestone doji, watch out, because we can see a potential change in the trend in the markets. Then we have a hammer and we have a hanging man. So a hammer is now in relation to quite a few candles where the market's coming down at a certain rate, and then a hammer forms, which, as I explained to you earlier, there was a bullish hammer and bearish hammer. In this case, it's a bullish hammer, which indicates that the price was testing the selling, was testing the supply, and then the market moved up, and it closed at the high price, which means that there can be upside to come. Now, these type of candle patterns are amazing for intraday traders if you're looking to trade price action and how candles work. It's also amazing for confirmation for when you are, for example, looking at chart patterns, and a chart pattern forms and then you see a hammer, which is either confirming a reversal or a potential continuation of a trend. You then have a bearish hanging man, so it's the opposite of a hammer, which basically signals that there is downside to come. The hammer formed, and after the upside trend, it has now formed a hanging man where you can expect downside to come, but always use confirmation indicators to help with your analysis. Then you have a morning star doji. Now, a morning star doji is the price is coming down, and then it forms this doji out of nowhere, where the open price is equal to the closing price. There was testing in the low, there was testing in the high, and this is quite a bullish candle where you can now expect the price to continue up. Similar to an evening doji star, which I find even stronger than a morning doji star, where you can see there is upward momentum, upward trend. It then forms this evening doji star where the open is equal to the close, and there is a form between the low and the high, which can indicate that there will be a reversal in the trend. You then have a morning star, which is very similar to the doji, except there is a little bit of a body. So the morning star, you can see it forms a type of spinning top in a way, but a bullish spinning top. And after a downside in the market, there is a morning star, which should give you morning glory. Did I just say that? It should give you upside momentum for the candles. You then have the evening star, which is the opposite of the morning star, where it forms right at the top of all the candles. And there is bearishness and downside to come, and it indicates that there is a change in the trend. Then we have the piercing line and the dark cloud cover. These are awesome terms, by the way. Piercing line, dark cloud cover. And yet they are the most laborious and boring candlestick patterns in the whole of candlestick charting. But anyway, a piercing line is where there is a down candle, and next to that is a green candle, and where the open price of the up candle is lower than the closing price of the down candle, and the closing price of the up candle is lower than the open price of the down candle. Vice versa with the dark cloud cover, where the open price is lower than the closing price for the down candle, and the open price is lower than the open price for the down candle. So that's a dark cloud cover. Not very cool, quite a boring candlestick formation. I wouldn't do anything with it, to be honest. Then you have the three white soldiers. Now, this is my favorite candlestick pattern formation. Watch out for them. They are coming. The three white soldiers shows you three consecutive grand up candles next to each other with great momentum to show that there is upside to come. These are excellent candles to identify reversal in a trend. The opposite are the three black crows. So the three black crows are showing you three consecutive red candles in whatever trend was happening in the previous, whether it was going up or down. These three black crows indicates that there is downside to come. It's bearish, and you got to watch out for them. So the three white soldiers and the three black crows. Those are 24 candlestick patterns that you need to know. That's the end of that. Masterclass lesson 15, range bounded buy and sell in between ranges. So you have a range bound setup where there must have at least 3 touches on the support and resistance line before it is considered a valid setup. So the more price touches that there are in the resistance and the support, the more validity this setup is for this type of trader. So you can see that there are 3 lows and there are 3 highs, which establishes that there is some buying activity and selling activity that can take place for a range-bound trader. So let's take a look at what we mean by that. And basically, these range-bound traders look for sideways consolidation box formations where they can trade in between the range, between certain lows and highs. They buy low, they sell high, they buy low, they sell high, they buy low, they sell high. Market breaks above, they wait for the range to confirm. And then once that happens with 3 touches, let's say those are 3 touches, they buy low, they sell high, they buy low, or in this case, they probably would have made a loss. They sold high, they bought low, they sold high. And this is how they do it. So here's an example with the Japanese index or the Nikkei 225. It's a great index to trade range bounded out of majority of indexes that I've seen or indices that I've seen. And I do know traders that like trading the Nikkei 225. I'm not an expert in range-bounded trading, so I cannot tell you exactly the statistics and how it works. For me, it's very boring to wait for sideways motions and then just to trade the lows and the highs, because there's only so much that you can go up, and compared to with trend trading or breakout trading, where you can just follow the trends and you can just carry on letting your gains continue up. Range bounded, unfortunately, there is a limit. And there are breakouts from those that there are many fake outs. So I don't have a lot of experience with range bounded. I just have an idea of how they go about it. Masterclass lesson 16, explained breakout trading. So here's an example of a chart with a bunch of breakout patterns. Now, what is breakout trading? Breakout trading is a strategy where a trader identifies a pattern, then buys or sells the market when the price breaks up or below a specified support or resistance in order to ride the continuous or reversal trend for profit. Let's go back. Let's say that again slowly with images. So breakout trading is a strategy where a trader identifies a pattern, can be any pattern, and then buys or sells the market when the price breaks up and out of that pattern or below a certain pattern at a specified or a chosen support or resistance level in order to ride the continuous trend or reversal trend for a profit. So let's do this in two ways. There are three steps with breakout trading. First is the wait. You wait for the pattern to form. The second is the break. You wait for the breakout with the market. And the third step is the trade. Once the price opens above the breakout level, just take the trade. JTTT, just take the trade. I'm going to put that on. I'm going to give it to you for free because most of you are not taking the trade. So just take the trade. Masterclass lesson 17, 3 steps to enter your breakout trade. Let's look at it with candlesticks. So step 1 is the wait. You wait for a chart pattern to form, in this case, a box formation. Step 2 is the break. Break is you wait for the breakout above the formation. Step 3 is the trade. JTTT, just take the trade. When the breakout has confirmed, that's your trade signal. That is where you get in. The open of it, you get in. And if you miss the open and the market continues up or down, just take the trade and change your stop loss and take profit according to your risk to reward levels. And step 4, the most important, once you've taken the trade, is leave it alone. Let the market take over. Once you've put in your entry and your exit levels, let the market take over. What indicator takes preference between moving average and RSI, or do you have them to align to trigger? I don't know if you're part of the premium multi-trader service, but if you are, you would know, or if you're not, or if you are, it doesn't matter. But the thing is, what I do is I put in all my moving averages. So 7 moving average, 21 moving average, the chart patterns price breakout using candles, and then the RSI with the 18 or 20. And I align them all together. And the RSI tells me the momentum and the confirmation of where the market is more likely to go. The moving averages also gives me an indication of where the trend is going. But I do not use the moving averages and the RSI for confirmation, as in for the execution for taking the trade. I just use it for peripheral. The RSI, the moving averages, if you want to put a stochastics or a MACD or the Bollinger Bands or the volume weighted average, whatever you want, I use it for peripheral. What I only use for execution is for the price to form a chart pattern, to break out. That's where I get in, regardless of anything else. International and local stocks, I use daily for indices. I use daily for commodities. I use 4-hour for Forex, and I use daily for cryptocurrencies. But mainly only Forex is where I drop my time frame to 4 hours. But sometimes I do use daily. It all depends on where the chart pattern is lining up. How do you calculate the take profit point and the stop loss point? Good question. I'm going to save that for a little bit later when I explain chart patterns, if that's okay. Masterclass lesson 18, 24 breakout chart patterns explained, revealed, all here, ready for you. Normally, I only reveal 5. Let's start off similar to what we did with candlesticks, and now let's look at chart patterns. So the first one is the ascending triangle. So I am going to probably go through this alphabetical order so that we can go through all the chart patterns. The ascending triangle is where the price of the market makes higher lows and same highs, which then converges to an apex, and then we wait for a breakout. And then you determine where the stop loss and take profit is. So where I put my stop loss and take profit is always above more than 1 to 1. So 1 1.5, so 1 to 1.5 is my risk to reward ratio. Or when the market is trending and is doing well for us, the risk to reward is 1 to 2, which means I'm willing to risk 1 to make twice as much. So with the ascending triangle, once the price breaks up and out of the resistance, I get in and I set my stop loss pretty much halfway between the formation, sometimes below it, sometimes below the whole formation. And then I set my take profit twice as much as where I put my stop loss. There is no magic level where to put your take profit level. Some people use Fibonacci's, others use regression, others use Elliott waves. It's all changing chaos into order. It's all within your own confirmation bias, nothing else, okay? There are no magic indicators. So it's as simple as the risk to reward of 1 to 2 or 1 to 1.5. So the ascending triangle was the ascending triangle was the first formation, and the opposite is a descending triangle where the price forms lower highs and it bounces on the same lows. Then the price of that pattern breaks below the support, and that's where you expect the market to continue down. And so you set your take profit twice as low as where you are willing to set your stop loss. That's the difference between an ascending triangle where it's ascending and a descending triangle where the price is moving down. Then you have a cup and handle, which is my favorite formation, which basically shows you a big rounding bottom and a small rounding bottom, which forms the handle, and a big rounding bottom that forms the cup. The price then breaks above, and I normally set my stop loss just below the bottom of the handle, and I set my take profit twice as high as where the risk is. So that's the cup and handle formation. Then you have an inverse cup and handle, where it's basically the opposite of a cup and handle. You're turning the cup and handle upside down, where it forms a big rounding top, which is the cup, and a small rounding top, which is the handle. And then the price breaks below the support of the cup, which is also known as the brim level. And then you set your take profit twice as low as where you would set your stop loss or your risk. So in this case, you would put your stop loss just above the handle, and you would set your stop loss, your take profit level twice as low. Okay, so bullish formation of a cup and handle formation, you're waiting for the cup and the handle to form, break out, and then you follow in the direction of the trend. And the inverse cup and handle is you wait for a rounding top, which is the cup, and a rounding bottom, small rounding top, which is the handle, break below, and then you're going to follow the direction down. Then we have the double bottom, which is also known as the W formation. And basically this is a formation where there's two rounding bottoms. The price breaks up and out of a resistance level or a neckline. In this case, we call this a neckline. And then we follow the direction of the trend, and we set our stop loss 50% of the W formation. You then have the bearish formation, which is the double top or the M formation, which forms two rounding tops. You wait for the price to break below the neckline, and then you will hold on to your trade as you expect the price to drop, and you will set your stop loss 50% in between the head of the top double top and the bottom of the double top. Then we have a falling flag. Now, a falling flag is where the market has been moving in an upward direction and it has a flagpole. Then the price moves in between a range, and that range forms what looks like a flag, not a pennant, not a triangle, but an actual little flag. And then we wait for the price to break up and out of the flag formation. We set the stop loss just below the bottom of the flag formation. So I like to give it some leeway. And then I set the take profit twice as high as compared to the where the stop loss is. So that's the falling flag. So the flagpole raises up, the price forms a falling flag, the price breaks above the falling flag, and then we ride it on up and take profits. The bearish is the rising flag. The rising flag is where there is a downward trend line. It then forms a rising flag with the price. We then wait for the breakout below the rising flag, and then we expect the price to continue down, as this is what you can think of as almost a small recovery within the bigger downtrend. So when there is a small recovery within the bigger downtrend, we expect the price to break below and continue down. And we, as always, we set our stop loss just above the formation so that we can give leeway in case the market does test these levels. So that's the difference between falling flag and a rising flag. We then have the falling pennant and the rising pennant. The falling pennant is very similar to the falling flag, okay? But the trend is moving up, and instead of forming a flag formation, it forms somewhat a wedge pattern, but it's also known as a pennant formation. Now, a pennant compared to a wedge is a lot shorter direction, shorter duration. When you think of a pennant, think of a short duration movement within an uptrend. So with a falling pennant, you expect the price to move down, and then once it reaches 3/4 of the apex, it will break above the falling pennant, and you expect the price to move up, okay? And then you can set your stop loss just below the bottom of the pennant, or give a little bit of leeway so that you can give the price to move around. Then you have the rising pennant, where you have a downtrend. The price then moves in a triangular formation up, and it forms a pennant formation, and then the price breaks below the rising pennant. Once that happens, you've got your levels. You've got your entry, which is immediately the open price of the candle that opened below the rising pennant. You have the stop loss, where you're putting leeway for if the price does decide to move up again. And then you've got the take profit, where the price will continue down and you will bank your profit. Then we have the falling wedge and the rising wedge. The falling wedge is a lot bigger than a pennant. So it looks like a pennant, it acts like a pennant, except there are a lot more candles. So a falling wedge is where the direction has been moving up in an uptrend. It then has a retracement of around 1 to 2 to 3 months of movement. Notice 1 to 2 to 3 months of movement within a wedge formation. The price then breaks up and out of the wedge formation, and you hold it because you expect the price to move up, and then you set your stop loss below the wedge formation to give it leeway. The rising wedge is the opposite of a falling wedge. It's when the price of the market has been coming down. You expect the price of the market to form a rising wedge. Once the market breaks below the rising wedge, that's where you get in. You set your stop loss above the rising wedge, and then you set your take profit twice as much of what you're willing to risk. Inverse head and shoulders. So the inverse head and shoulders is a bullish formation where it forms a small rounding bottom, which is known as the left shoulder, a big rounding bottom, which is the head, and a small rounding bottom, which is the right shoulder. It then forms, the price goes up and down until it hits a neckline. The price breaks above the neckline where you go long or you buy, and you set your stop loss below the bottom of the right shoulder. So you set your stop loss below the bottom of the right shoulder, and then you ride it on up until it hits the take profit. The opposite of an inverse head and shoulders is a head and shoulders, where it forms a rounding top, a bigger rounding top, and a smaller rounding top again. So the left shoulder, the head, and the right shoulder, the price breaks below the neckline, you hold it, you set your stop loss above the top of the right shoulder. You set the take profit at the about 2 times more than what you're willing to risk at around this level, and Bob's your uncle. The rectangle formation, bullish. So we've already done this before. You wait for the price to form in a rectangle formation. The price breaks above the resistance where you get in. You set your stop loss, sometimes 50% of the rectangle formation. If it's a small rectangle formation, then set your stop loss below the entire formation, but make sure the take profit is twice as much of what you're willing to risk. The opposite is a rectangle formation, but bearish. So what I call this is a bearish box formation sometimes. The price forms a box formation, and instead of breaking up, it breaks down. You set your stop loss at 50% of the height of the box formation or above the box formation resistance, and you set your take profit twice as much that you're willing to risk. Then we have a simple rounding bottom. Now, this is pretty much one of the easiest formations you see, but also quite common. So you see a big rounding bottom form. There is a neckline. The price breaks above the rounding bottom. That's where you hold it. You set your stop loss about 50% of the height or below the rounding bottom, depending on what you want to do. And then the rounding top is the opposite, where it forms a rounding top formation. It then has a stop loss 50% of the height. And then you set your take profit way below, about 2 times of what you're willing to risk. Symmetrical triangle. Now, a symmetrical triangle is similar to a wedge, is similar to a pennant, except this is where the triangle pretty much is symmetrical, believe it or not. So it moves in a sideways formation, and instead of converging on a downtrend or an uptrend, it converges sideways. And then you're waiting for the price to break up, and out of the symmetrical triangle, this is bullish. Then you set your stop loss just below the symmetrical triangle. You set your take profit way above, 2 times, or whatever you're willing to risk. Make sure it's a little bit more. And the opposite we have is a symmetrical triangle bearish. And this is where the price is coming down. It forms a symmetrical triangle. It breaks below. You set your take profit twice as much as what you're willing to risk. So I like to set my stop loss just above the resistance of the symmetrical triangle, so that we're giving it leeway and we're preventing fake outs. We always want to prevent fake outs with trading, and we do this through experience. So that's a symmetrical triangle. Triple bottom is like a double bottom or a W formation, but it has 3 rounding bottoms. As you can see, it has a neckline, and you wait for the price to break above the neckline. You then hold on. You set your stop loss 50% of the height or below it, depending on what you want. The opposite is a triple top. A triple top, it looks like a head and shoulders formation, except the rounding top is at the same height as the head, is at the same height as the right shoulder. So the triple top looks like this. You wait for the price to break below. You set your stop loss 50% of the height, or you set the stop loss above the formation itself, and you make sure that the take profit is 2 times of what you're willing to risk. And I think we are coming to the end with the broadening bottom, or what I call a vuvuzela formation. If you've been with me since 2013, you would know exactly what I'm talking about. So broadening bottom is where the price broadens and forms a triangle formation, but broadens from the beginning of the formation to the end, and then it breaks out of the broadening formation. I like to set the stop loss below the entire broadening formation and the take profit 2 times higher. And then we have a broadening top, which looks more like a vuvuzela, where the price forms a broadening formation where the price hits higher highs and higher lows, or it kind of depends. This is more of a subjective type of formation that you can see when it's converging out, and it forms a broadening top formation. And then you can set your stop loss either 50% of the broadening formation above the broadening formation, but the most important thing is to set your take profit twice as much as what you're willing to risk. Wow. Are you ready to level up your trading? Introducing the premium multi-trader service and Forex premium service. What is it? The premium multi-trader and Forex service, which was established in 2020, is an online email and video service to help anyone profit on the go with live trading alerts from both local and international stocks, indices, Forex, and cryptocurrencies using a 2-decade-old proven and profitable trading strategy called the multi-trader system. How do I choose trades? I use a 2-decade high probability trading strategy. I risk no more than 2% of my portfolio per trade, and I gain up to 4% per gain per trade. How? I use a breakout pattern trading strategy, which you all know now. My secrets are out. And the markets, I do trade local and international stocks, indices, currencies, and cryptos, and soon commodities. But I have a very important announcement first. What's important about the strategy is that there is no guesswork. There are no emotions. It just works. It just makes me a living. It's helped me trade for a living for the last well over a decade, and it continues to do so. And now having this community of growing our wealth together and being in this winning streak that we're in at the moment is just so rewarding to do this together instead of just doing this alone. I use a profit rule that has kept the win rate to 62.5%, but strangely enough, it is going up. The statistics of the win rate is going up to 65%, which is amazing. It's not done that in many years. So it is working very well with the multi-trader system. And also because I've run these trader services for the past 8 years, I've listened to everything you've had, from worries to concerns to what you really love. So I am building, I'm evolving, we're changing, we're creating. And that's the beauty about this premium service. So what will you get when you join the premium service? First thing, you get weekly email buy and sell trade alerts. I hope you're not worried about getting too many, because sometimes I just want to send you a video, a lesson, a calculator, more trading analysis. Sometimes I send you blind analysis. I love those. Which markets to trade and why, precise entry and exit price levels, easy to visualize chart setups, follow-up email trade updates. So this is very important, because this is when I tell you when I lock in my trading profits and when I cut losses, and also when I move my stop losses to grab those gains and lock them in to see how our current trades are performing. You'll also get the welcome guide on how to start and make success from trading, a 5-step checklist to action each trade perfectly. You'll also get online trading videos and updates, discover new high probability trades lining up, learn insider trading tips and profitable strategies. 3 risk trading calculators, know how much to buy or sell per trade. Fast track your weekly trading performance. You'll also get broker and charting platform letters with 3 highly recommended companies. And basically, this is how it works. You read your email, you calculate your trade size, you enter your trade, you lock in profits, you wait for the next trade to line up, and you wait for the next trade update via email. So for you, I've obviously dropped the price from 4,200 to 1,500 Rand, which you can join today. Many of our members are staying on board, and that is what's keeping me going, is that knowing that it is bringing value to you, knowing that it's bringing the profits that you deserve and the success that you deserve, and that we can build this community of successful traders and changing that 5% of successful traders to more than that, all right, 20%. And for multi-trader, hopefully way more if we are doing this together. So we've come to the end of the Multi-Traders event, Ultimate Trading Strategies Masterclass. Whether you're a novice or an experienced trader, you're about to learn many new tactics you can apply to your trading throughout the Multi-Trader events. The Multi-Trader Complete Commodity Masterclass will be next. So to secure your 50% discount, I want you to fill in this quick 2-minute survey, but I also need you to fill in this 2-minute survey. And the reason is because I need to know where to send your book to, and I need to know what you thought of this event. So what I'm doing is I'm sending you, I'm sending you this link quickly to everybody. Just click on this link. It might work for majority of you. It might not work. I'm not sure. Sometimes it doesn't work for 1 or 2 people. But anyway, fill it in, the survey, so that I can know exactly what you thought of this free event that I've done for you. I hope it's helped. This will also help us improve your experience for trading. Okay. And when you're done, please let me know. Just write done. So comment done in the chat when you're done with the survey. I will answer all of your questions. I'm not in a big rush. It's Saturday. I know you would like to enjoy your Saturday, but this doesn't come often. I've never done this free event before. I'm very excited about it. I'm happy to do another one if it's helped you today. So let me know, as we still have a bit more to cover. But anyway, talking about the next event, which is taking place, I think on the 17th of September, is the commodities webinar. So I will be incorporating commodities into the premium service. And I think it's a great way to start trading commodities, the precious metals that you love. Now that crypto isn't doing as great, I think people are going to be moving more to commodities. They're going to be going back to gold. And I'm sure you're happy to hear that. Is that the safe haven, once again, could be gold. So what we're going to cover in this webinar is what is the commodity market, inner workings of international commodities, how to read commodities with ease, 7 best commodities to trade, 4 fundamentals that move the commodity market, how to buy and sell commodities, commodity fundamentals and news events to watch out for, how to trade commodities, CFDs, and spread trading, essential commodity risk calculator, 8 profitable trading strategies for commodities. So we're going to apply those strategies to the commodities. But then I thought about something else, and something I want to do is that I'm going to, right in front of you, make 7 full predictions on where I expect these commodities to go. And I think it will help if we look at where is gold going, where is oil gold, or where's oil going, where are the precious metals going. I want to do prediction analysis. So what I'm going to do, because this link is only special to you today, and it is not going to be the 900 and something rand that I normally charge. I just want you to just go to this link, sign up for your discount. It is really low. It's less than what you spend at McDonald's, probably. It's going to be an amazing webinar. We're going to talk about a lot of things regarding commodities. I'm incorporating it highly into the Premium Multi-Trader because we need to evolve. I thought, if I have to be honest, that cryptocurrencies were going to be huge for trading. And now looking at this crypto winter, seeing Luna crash 99%, seeing Bitcoin crash 30-40%, there isn't that security that I have as much as what I thought, because the blockchain is amazing technology. It is the future. Soon you're going to be holding your own NFTs. You're going to be running your business through NFTs, non-fungible tokens. Blockchain technology is going to be doing voting. It's going to help with medical. It's going to keep your records. Everything is blockchain. So I'm not going against it. I'm not one of those guys that are saying it's never going to work. But I am saying that at this stage, cryptocurrencies is a little bit more volatile and dangerous to trade. Because if I send out a trade on Litecoin and then next thing it's crashed 99%, my hands are tied. So all I can do now is protect you and to say I'd rather send more trades on commodities than cryptocurrencies. Does that make sense? This price, I've literally only dropped it for you, so I hope it works. I'm sure you really want to know where is gold and oil going. And the thing is, it's going to be my opinion based on experience on how I do chart analysis. And if I'm wrong, I will tell you that things have changed. But commodities, I've had a pretty good knack on with predicting. And oil, when the thing is, when you're predicting, where gold is going, You're basically predicting where world markets are going, where inflation is going, where gold stocks are going. Same with oil. Now, oil is difficult because it is complicated. It is linked to every single business in this world. So yes, book your ticket to the commodities event and make sure you sign up to the premium multi-trader if you haven't done so. What I will do is when you sign up to premium multi-trader, because it's top of mind, I will send you the last month worth of trades and updates and communication so that you can catch up exactly to where you need to be. Instead of just getting some random trade on Monday, you will be having all of the trades and updates for the last month. I'm talking about July, from July all the way through to August, so that you can see exactly what we're doing with the portfolio. And I've got it top of mind. I've got it written down. I use my sticky notes. Here's the event that you can book through. Remember, I'll be sending you the videos and the slideshows and the calculators and the book. Remember the chart patterns book. You probably have it by now, but it's very good to have. Print it out. You now know how it works. There's so much talking lately on hyperinflation. Is it to be concerned? Inflation, unfortunately, leads to the first thing is that prices are going to go sky high. So people are not going to be spending as much. And what they're going to be doing is they're going to be putting their money and depositing it into the bank when interest rate starts going up to curb inflation. When this happens, people are going to be getting out of shares, out of commodities, out of safe havens. They're going to be going straight back into the bank. And then the markets are going to crash. Simple. So inflation does not have a good effect on markets. But then it gets to the point where the crash invites more buyers when the prices have dropped to such an extent and the PE ratios have dropped to equilibrium levels again, which is basically how a bubble works. And then that buying sensation that takes place, which I absolutely look forward to, goes to the point where you make up for all of the losses during the downward periods. I hope that helps. Goodbye, goodbye, and goodbye.